Good evening, everyone. Russia retreats and Wall Street gets a massive relief rally. Investors bought up stocks after Russian President Putin pulled troops back from the border of Ukraine, allaying worries about an imminent military showdown. The major averages surged 1.5% or more, posting their biggest gains so far this year, even setting a new record close for the S&P 500. Now, those sky-high gains wiped out all of yesterday's losses, and even Russia's stock market, which lost 12% on Monday, rose more than 6% today. Here's a look at the closing numbers. The Dow soared 227 points. The Nasdaq ended at a fresh 14-year high, adding almost 75 points. And the S&P jumped 28 points to 1873. That's a record high. Over in the commodities markets, what was up yesterday was down today. Oil prices fell $1.59 a barrel to $103. And gold lost $12 an ounce to $1,337.
Well, Susie, even as Russian President Vladimir Putin said today that his country has no intention of fighting the Ukrainian people, international support for Kiev is growing. U.S. Secretary of State John Kerry was there today expressing moral support along with a massive aid package, and he spiced in some tough words for Russia.
If Russia does not choose to de-escalate, if it is not willing to work directly with the government of Ukraine, as we hope they will be, then our partners will have absolutely no choice but to join us to continue to expand upon steps we have taken in recent days in order to isolate Russia politically, diplomatically, and economically.
Steve Sedgwick is in Kiev with the latest developments and the challenges Ukraine's interim government still faces.
Here in Kiev on Tuesday, a slight lessening of tensions. For the first time since the start of the crisis, we've heard from the Russian President Putin, who appeared to say there would be no Russian military activity across Ukraine. He failed to answer, though, the questions about whether there were 16,000 Russian troops on the Crimean Peninsula and what their activities were in that region. Elsewhere, we've seen U.S. Secretary of State John Kerry offering support to the fledgling pro-Western government. He offered $1 billion in loan guarantees plus technical assistance to the government as we run up towards those May 25th presidential elections. Elsewhere, no word yet from the IMF. The IMF is in town talking to the finance ministry about both short-term and long-term financial support, which is much needed for this young government here in Kiev. Steve Sedgwick for Nightly Business Report in Kiev.
Our guest tonight says that Wall Street is in a long-term bull market, a belief that she's held before, during, and after the Ukraine crisis. Ann Sonders is Chief Investment Strategist at Charles Schwab. Hi, Ann. Nice to have you with us.
Hi, Susie. Thanks for having me.
All right. So investors seem to be behaving today like this crisis is all over. Is the worst over, or could there be another round or two?
I think even if I pretended to be a geopolitical strategist, I couldn't answer that for sure. I think perhaps what Russia was feeling and what Putin was feeling was the effect on the economy with the kind of drawdown we saw in the market, the weakness in the currency, the implications that had for inflation, the sanctions, particularly on the elite. There may be some second guessing. But to assume that because the market rallied 227 points today, that the market is telling us this crisis is fully over, that may be a stretch.
You know, Ann, we heard last night from Warren Buffett, who said, if you own a business tonight, are you going to sell it because of what's going on in the Ukraine? If you own an apartment building, you own a farm, are you going to sell it because of what's going on in Ukraine? He said, of course you wouldn't. I assume you agree with that.
I do, and I really, truly believe that the chances that we look back at whatever point this bull market ends, and I think it has a ways to go, we are unlikely to say, what do you know, it ended because of the Ukraine. Geopolitics can cause short-term gyrations in the market, particularly if it impacts commodity prices, energy prices. There are those transmission mechanisms. There's a confidence hit, too, but they don't tend to mark the ends of bull markets. In fact, more often than not, they tend to be buying opportunities.
Ann, you've told us that the U.S. stock market is your favorite one, but as investors look around the world for where they can get some really good rewards, even in the face of some risks, why do you like the U.S. and how does it fit in with the rest of the world?
Well, I do think not only is the United States in a secular bull market in its own right, but I think it's in a secular bull market relative to emerging markets. Now, we're not negative on emerging markets. We have about a neutral rating, and but do like the developed markets more than the emerging markets. So I would say ranking them, if we don't tend to do that, I would put the U.S., Europe we think is attractive, and then down from that would be the emerging markets. We're a bit on the fence as it relates to Japan because of the near-term risks that they go back into a recession.
Let's drill down a little bit more, because I was going to ask you about your view of emerging markets. Are they more vulnerable in the short term to the geopolitical developments in the Ukraine or elsewhere? In other words, could other emerging markets be tarred or drawn down because of fear about what people see in Ukraine?
Well, certainly the economic connections, the import-export relationships, whether it's between the Ukraine and Russia, the Ukraine and Europe, Europe and Russia, is certainly much tighter and much more meaningful than what we see in the United States. What I would say within the emerging markets is that differentiation is becoming much more important. You can't look at the emerging markets as a singular monolithic thing anymore. The tide is not lifting all boats or taking out all boats. I think there are several factors that will define whether you're on the sort of winning end of emerging markets or on the losing end. And it's a function of whether you've got an inflation problem that might prevent your central bank from easing policy, whether you've got a current account deficit, whether you are on the production side of commodities or on the consumption side of commodities. Clearly, there are some particularly hard-hit emerging markets. Leaving the Ukraine aside for a moment, you've got the now so-called Fragile Five, which would be Brazil, India, Indonesia, South Africa, and Turkey. And those are some of the most beleaguered areas, but there are also going to be some winners. In fact, we have a fairly optimistic view on China, which is by far the biggest within the emerging market sphere.
Wish we had more time to explore that with you. Liz Ann, always a pleasure talking to you. Thank you so much.
Thanks very much for having me.
Liz Ann Sonders, she's Chief Investment Strategist at Charles Schwab.
Now, if you were wondering which well-known U.S. companies have some of the biggest exposure in Russia, we got some names for you. Among them are General Motors. It makes about 100,000 cars a year at a plant near St. Petersburg, and it's hoping to expand operations next year. Ford operates 3 plants in a joint venture with a Russian automaker. ExxonMobil formed an alliance with Russia's state-owned oil giant Rosneft back in 2011, exploring for oil in Siberia and in the Arctic and the Black Sea. And banking is big over there. Citigroup holds more than $10 billion in assets in Russia. That's its 10th largest emerging market. J.P. Morgan Chase's exposure there is nearly $5 billion.